we've already talked about some of this stuff, but you can see on the right-hand side of the screen that this is from the Journal this morning, small business loan funds nearly used up. And of course, that's across all the media everywhere. They basically said on track to exhaust most of the initial allocation of 350 billion in the early morning hours on Thursday. And I think, and this morning I've heard that's pretty well gone. 1.5 million loans valued at more than 324 billion. So there's not much left. The interesting thing, and of course they're trying to get another $250 billion passed through the legislature. I don't really know what to think about that or how that'll come out. It's turned into a huge political mess, and it's anybody's guess as to what's going to happen. I think that as David and Edgar alluded to, and based on this new group, Facebook group that they started, it's a little bit crazy. I noticed this morning there were a few people that said they'd gotten their checks today, but there are an awful lot more who haven't heard or seen anything. I know that our firm, Red Fusion, we put ours in the very first day with our bank, and they haven't gotten directives. The loan officers haven't gotten direction down from the top as to what to do or how to go about it. So, does that mean we're in line? We're not in line? The money's gone. This is over. So there's just a million questions. And I know that now, Ed, you've had some experience. Ed, as a financial guy and a lot of banking experience in his life doing big loans. Ed has worked with a couple of his clients and put some stuff in. Have you got any updates on what might be going on with any of your clients and whether they've heard or gotten any checks?
Yeah, my clients have gotten their money.
Really? Okay.
Yeah, they were on top of it at the beginning. They had a good relationship with their bank, and I think that's really important. And we worked through it, got it in right away. First day, we filed all the paperwork. And it was hard because there weren't established definitions on this, what's included in the payroll amount and what is excluded, et cetera. So we had to do the best we could. And what they found interesting is I work with a lot of other CPAs, and they all want to be perfect. And I had to convince them, rather than being perfect, we had to get our application in, and so that we were first in line. And we eventually got all that done, and I'm really happy. They wanted to make real minor changes at the end, and after we already filed, because everything has to be perfect. And if we would have done that, we wouldn't have got our money. So anyway, I've learned a lot about this, and I see there's not only the PPP program, but there's also this disaster relief program. And the disaster relief program is a loan that could be up to 30 years at a 3.25% interest rate. So it's very, very attractive. The PPP is a loan for just 2 years, 24 months. So the payments, the payback, if it's not forfeited, if the loan is still in effect, you got to pay it off in 2 years. That's very aggressive. Especially, you bankers know that when you get that type of a time frame ahead of you. But the disaster relief program, you can do it over 30 years. So the PPP has a personal guarantee, has no personal guarantee, whereas the disaster relief, you have to have personal guarantee or some pledged property, which could be a house, your home, etc. So anyway, it's been very, very helpful. And now we're trying to plan to make sure that when trying to understand the definition, at the end of June, they're going to do some type of assessment. And whatever that assessment is going to determine whether your loan is still in effect or if it's been forgiven. And so we're waiting on those rules, and those rules are supposed to come out today. Maybe they have, I haven't seen yet. So the bottom line is they want to make sure that on June 30th, you have most of your people still employed. And that's the key there. So
yeah, right, great. Yeah, good comments and from the front line, and some of those have been pretty big loans. And it kind of makes one wonder if and this kind of been Ed's position all along is that your relationship with the bank that probably has a whole lot to do with whether or not you got in line or not, and what was happening. So, Ed had really good experience. I've talked to a lot of little people who have had horrible experiences. The people on the few that I've read on the Facebook page, I think one of them said that she got a check. We were talking about very, very small checks for maybe one, two, three people. And she had gone through some strange financing outfit that I'd never heard of before. So there are these unorthodox financing people that are participating. But for the most part, from what I'm hearing, it's kind of a big mess. And it's too bad for everybody that it's not organized a little bit better. So in that vein, I was thinking about, well, what can we do to really help out? And I know that Ed and I have worked with clients. I only have two clients now that I'm on the board of two accounts, and as I'm really retired and spending my time with MicroGiants and mentoring things. But in the stuff that I've done, and I think Ed too, we have to go through some process to figure out, well, how much money do we need, and when are we going to run out of money, and that kind of thing. And so, in our group, we've talked about cash flow planning as being the lifeblood of any business, and it's really cash that drives people out of business. It's not the fact that you're not profitable that causes you to go out of business. It's that you don't have any more money to pay your bills. And so cash is really king, as they say, and that's certainly true today. I think in this particular case, because of on the PPP, because the no guarantees and the ability to have it as a grant, which is new to me in my 50 years in business. I've never heard of anything like this ever. And so it's quite a strange circumstance, but a lot of people were just kind of saying, well, let's just go ahead and apply for it. And I'm not sure that's bad information or bad idea. There's an article in the journal this morning about the ethics of applying for a loan if you don't really need it. I had that conversation with one of my clients. They had kind of said, no, they're not going to worry about it. They happen to be so busy because of all that's going on that they're overwhelmed with just operations, and they weren't thinking about it. So, but when I really said, wait a minute, I mean, you don't understand what's going to happen in the future. Things are totally crazy. You could lose a lot of people to the virus itself. You ought to apply. And they were able to get a hold of their CPA. In fact, I called the CPA. He's on the board with me. He serves in a capacity very similar to what Ed does with his clients. And like Ed, he was able to put together a loan in an application for them that includes 5 or 6 of their companies. And he got that done in one day, and I think they turned it in the following day. And I know Ed had spent 16 straight hours on working for those. So it's sort of like the people who understood what was important, the ones that got their stuff in. We'll see how that goes. But I think an underlying issue is, well, how do you determine your cash? And what does it mean to know where your cash is other than just looking at your bank account? Because really, what's in your bank account is only the result of all the other efforts that it takes. So I thought what we'd do is start at the beginning, and unlike what we've done in the past, I figured we couldn't get through this all today. And actually, some of you will be able to contribute beyond where I am, because in a way, my cash flow experience is just based on being in a business that's growing 60 or 70% a year and buying lots and lots of inventory at a turnover of 2 or 1.9, and simply running out of money because I was growing too fast. So that's a different kind of cash problem than we have today. You know, today the funnel's been turned off and it's just gone to zero, and or very close to zero. So we're in a completely different circumstance. So what I thought we would do is kind of begin at the beginning and go through the things that I've done in the past. And Ed, and those of you who've done cash flow, please chime in, correct me if I'm wrong. But this is kind of how I've done cash flow planning for about 40 years for myself and for clients. First, I thought I would just kind of do a fun illustration and explain what cash, you know.
Ron,
Yeah.
are we supposed to see your screen?
Yes, you are.
I don't have it on me. Does anyone else have it?
Thank you for saying that. I will share it again. It shows it sharing there. Now, can you see it? You know what I think might be happening? I've got it in presentation mode. And okay, we'll just do it this way. Can you see that?
I cannot.
I can.
I can.
You can?
Yeah, I can see
Let
it.
me check what I'm doing.
Yeah, so you should be able to see my sheet here. I'll try and max it.
You're the, I think it's my settings, the way that I have it. I flipped it. Now I know what's going on.
Okay, very good. So what I thought I would do is just do a little illustration of where cash comes from and where it goes. And there are a lot of nuances to this, but in the really simplest way, let's see, I'm going to switch over and see now. Can you still see this, Edgar?
Yes.
Okay, good. So I'll go back to the presentation. So let's talk about all of the streams of income as they come into the business. First, we got cash sales. Now, it's important that we talk about cash sales differently from sales, because if you sell on any kind of credit, then that means that goes into accounts receivable. So if you have vendor credit and you extend, say, 30 days to pay the invoice, you record that in your financials as a sale, but you actually post the cash portion of that over into your accounts receivable journal for that particular customer. So you've got a combination of sales. One is accounts receivable and the other is cash. Together, these do not make up, quote, revenue. That's different. That's an income statement. That's not a cash flow statement. Then we've got a couple of other categories. Loan proceeds. Now, if you happen to get a nice big loan for 2.5 times your payroll, then that's another source of income that comes into the bucket. And we've got the sale of assets. If you have a machine and you sell it and you get a check for that, then that's something that comes into the business. And then, of course, we have owner investment, which really could be sale of stock, new stock. It could be money that you are loaning back to the business in the form of a loan, but that's really a loan proceed. It's not cash into the business. And a lot of times there's a lot of money that goes back and forth with owners. Some in very small businesses, sometimes it's all intertwined with your personal account, which is kind of a bad way to know how your business is doing, but that does happen. And then I put another one over here because I figured Ed would come up with at least one more source that I forgot. Ed, can you think of anything else that is an inflow of just straight cash into a business that I've missed?
Well, you mentioned investments, right? People buy stock or invest in their business.
Yeah, that would be like an owner investment. That's what I've got there.
Yeah, and you have loans, right? And then that's a big topic right now. Loans come and bring in cash to your business to help you.
Yeah.
And you talked about the sale of fixed assets. You talked about revenue. I think you hit them all.
Okay, good. Well, you've been a good teacher. So what happens then is that this comes in and it just kind of goes, down this little gutter into this bucket. And the bucket is your bank bucket. That's your bank balance. But the only problem is that you've got all of these holes in the bucket. You've got your cost of goods sold. Now your cost of goods sold is, you know, your material costs. And of course, it includes labor and some other things. But in this particular case, we're not including labor because we have another category for expenses. So you've got all of your regular expenses and then your cost of goods sold. They're both expenses. I broke those out.
Oh, Ron,
Yeah.
I did not want to interrupt the meeting because I thought it was my computer that I couldn't see your presentation.
Yeah,
But
same. Open it too.
you can't see it. Anyone can see the presentation or no?
No,
No,
I
It
saw
stopped
it.
like in the middle of your. I was just gonna like say I think I can figure this out without it, but I don't think I can see your presentation now. Everyone can, and it's no longer just me.
So nobody can see the presentation?
Not
Well,
now.
yeah, not now. It was fine in
It
the
was-
beginning, and then mid like presentation, it switched
Yeah.
back to the everybody mode.
No kidding.
So I think in the very top right there should be gallery view or something, presentation mode or something. I don't know,
Okay,
somewhere
let's
in
go
there.
back. I think, yeah, I don't know. I've done presentations pretty reasonably before, but
Yeah.
let me go back here and find the bar. Let's see.
It looks like Christy, my wife, joined.
Oh, good. Hi, Christy. There you are. Christy's here. Okay, I'm going to share the screen again, and I'll just keep it on this last presentation page. All right, now everybody should be able to see that again.
Yes.
Yes.
Okay, so what we have then here is we've got all of the income, the dollars streaming into the bucket. We've spent our money on our cost of goods sold, on our expenses. We have loan payments in addition to that, and we've got asset purchases occasionally. And if we're really lucky, we've got an owner's draw or dividends, which would come from profits. There are different ways to do that. Kind of depends on if you're proprietor, if you're running it with your other expenses or with your personal account. If you've got a corporation and your books are completely separate, then you can take owner's salary, which is an expense, and then you might take profits out. But at some level, you know, you're taking money out of the business. So the interesting thing is that the difference between what flows in the top and the difference between what comes out all of these holes, there are lots of holes, is this little area right here that's supposed to be water. And that is your bank bucket balance. Now, a lot of times their holes are too big and your balance is down here to zero, just about as fast as it comes in, because you get your deposits for the day, your cash deposits for the day, you put them in the bank, you write a check, and you're keeping it down to zero. I know how to do that pretty well. Because not that that's something that you should do well, but because I had a business when I was in the retail business, I had started with one store, ended up with 7 stores. I was young and really ambitious. And so for those of you who are young and ambitious, you might want to remember this. I pushed my business too hard. I pushed it to grow as fast as I could grow, meaning the market was very large compared to what I was able to capture of that. I didn't have very much competition. And so as a result, I just continued to grow as fast as I could. And of course, in those days, I fueled it with inventory. And amazingly, the banker told me the more inventory you have, the better. And I learned years later that was really, really stupid, that you have to turn your inventory over as fast as you can. And if you turn it too slowly, you end up like I was. And that is, you're growing at 50 or 60%, but your accounts payable are growing by 80 or 90%. Why? I was buying too much inventory. And so I thought that the more I bought, the more I could sell. It was true. The more I bought, the more I did sell. However, along the way, you end up having some bad merchandise. And that bad merchandise has to be marked down. And then your cost of goods sold as a percentage goes up. And when that happens, guess what? The hole is bigger. And so instead of catching up, I would put things on sale and I would create cash so I could pay invoices, but my cost was mathematically going up. And so my profit was going down and I wasn't creating good, real cash to pay those bills off. So you can overgrow a business, and there's a formula actually for how fast you can grow. Now, one of the things we could do is we could come, in fact, we did. So we went to SBA and we went over to the loan proceeds thing, and and this is a long, long time ago. Borrowed $100,000 and went through the pain of getting that loan, and it was painful. But I was able to buy my partners out with their loan proceeds, which they requested that I do. And then what did I do? I put it all in inventory. So I had all this inventory, and my inventory went way up and my sales went up, but not as much as my inventory. So guess what? My cash never got any better. The other thing that happened is that as I'm trying to struggle with this problem, I'm going to my accountant and I'm saying, I don't have any money. Where's the money? And, well, the report was, well, I can give you a sources and uses of funds statement. That's fine. That tells me where I use the money, but it didn't, in the past, it didn't tell me anything about where the money was going to come from and what my bank balance is going to be. That's when I had the eureka moment. I went back to my business books. This was 5 years after I was in business. And I looked all through the whole thing and I found a teeny weeny paragraph on cash flow. And what did they talk about? They talked about sources and uses of funds. They did not talk about doing cash flow projections. So what we're going to do is do kind of a detailed look here. We're going to dive really into it. And I'll show you how this actually works and how you can actually do this. Ed and I have had a lot of conversations about this. And I think Ed agrees that from an accounting perspective, accountants, CPAs don't like to do cash flow statements. And the reason is that there are projections involved. Typically, accounting looks backwards. It looks at what you've accomplished, what you've done, where you spent your money. It doesn't look forward. It doesn't do sales projections for your sales team. It doesn't do a very good job, although it can, to take a look at receivables and try and figure out what your receivables are. There's still a little bit of interpretation, and so you kind of have to go that direction and do some interpretation. So what I did is I came up with, and then what I'm going to do now is I'm going to share another screen with you. So we're going to stop that share, and I'm going to do a new share. And we're going to go to this spreadsheet here. I hope this is the right one. That's not the right one. Sorry about that. Okay. Here it is. Okay, so I'm going to show this to you. Can you all see this all right?
Yeah.
Right.
No, that's not the wrong. Let's get rid of that one. Oh, you can't see that. Did it go away?
It's frozen.
No, let's see. That's not shared. It disappeared on my screen. That's interesting.
Did you minimize it?
Might have by mistake. Let's just find out. Yep, I did. Okay. Okay, what I want to do is, so can you see that now?
I can only see 3 columns.
Good. Okay, that's perfect. So I didn't want to show you this whole thing right away because I wanted to focus on a couple of things. So what I've done is I've simply reproduced the faucets are under income, and the outflow are all of the holes in the bucket. So it's as simple as that. So we've got our cash sales in one column, or in one row, our accounts receivable, loan proceeds, asset sales, and owner investment. So those are all the things that are coming into the business every single week. and I like weekly ones. These can be done daily as well. When you do it daily, you tend to have a lot more, in my experience, tend to have a lot more ups and downs. And so you say, well, I know what my cash sales for the week are going to be, or estimated. And because I've got 5 days of business in there, the chances of them being close are better than if you have a single day where it's going up and down quite a bit. So I like a week, but I've done them by the day. And then so on the outflow, these are the holes in the bucket. The big one is usually cost of goods sold based on the kind of business. If you're in manufacturing, it's a little bit less, but it can still be a huge number, and you have to pay your vendors pretty fast in many cases. So sometimes, your accounts receivable, you give them 30 days, but your suppliers, they might give you 10 days, maybe more if you've been around a long time, but there's a gap. You need cash in your bucket in order to be able to pay for that. So then you've got your expenses, whatever they are, and that's a wide variety of expenses. And then you've got your any taxes, any asset purchases, any loan payments, and then whatever you might take out as your owner's draw. And in this case, we're saying, well, you got to have enough money to live, and so we'll take $4,000 out. So it's really pretty simple. All you do is you take your beginning bank balance, you add in your total inflow, and you take out your total outflow, and this is how much money is going to be in your bank at the end of that week. So you see, it's pretty simple. It's a very straightforward calculation. Now we need to get into, well, how do I determine sales? That can be another story. So here's what I've done. I've looked at, I said, well, it's $40,000 per month. We have 4.2 weeks in a year, and therefore that's what my average is going to be. I could take this and I could spread it all the way across and do it that way. Ed and I work on an account where we're using different customers, and we spread them out 3 years of our experience with them. All the big ones represents about 60 or 70% of their business. And so we plan them and forecast them by customer, month by month by month, out 13 months into the future. So that's another way to do it. Another way to do it is just to sort of ballpark it and say, well, I know that I'm going to have more business next month because Joe told me he was going to come, and more the following month because I've got another order coming. So you can do it that way. So there's several ways to do your forecast. Accounts receivable, there are several ways to do this too. And Ed, you can chime in here. I just was using a method where I said, I've got 100,000 in our current accounts receivable and our average days outstanding, which is an accounting report. So you go to your accounts payable receivable report. Okay, it's taking 45 days for them to pay us. And then that just tells us what our monthly or our weekly receipts would be. So that's how I did that. So we can talk more about the details there, but now let's spread this out a little bit so you can see what happens when we begin to look at a cash flow plan. Now, the important thing here is where we are right on this line. In fact, we should just make sure that you can see that okay, because that's pretty important. That's what's important about what's going on here. And so based on where this little hypothetical business is with our sales sort of increasing here for the next 3 or 4 weeks, accounts receivable going up, everything doing pretty well there. Then we take a look at our inflows as generally going up. So that all looks pretty good. Then on our outflows, we've got, which is to be expected. We've got our cost of goods sold going up too because our sales are going up. Then we've got our expenses, which tend to go up and tend to go down. They might be more straight line than this in some businesses. We've got a couple of miscellaneous things. We've got a tax bill due in week 4. And then we got a humongous tax bill in week 7. That's our income tax for last year. an asset purchases, we have to buy a new machine, or we've got to have a series of computers, or whatever that might be. And so if you're an intensive asset company where you need a lot of investment, you might be buying things, several times a year. So when we take a look at just these calculations, which I just sort of plugged in for an example, you can see that we go from our $1,600 and $3,800 in the bucket, and then all of a sudden we're $19,000 in the hole. Wow. This $30,000 purchase is not going to work, is it? Well, what do? Well, let's push it off for a month, and you can see what happens. Well, now we've got $10,000 here, but we got a $9,000 problem here. Well, so then we can take that and we should push it off for another month. Now we got a $20,000 and we're only down to a $1,400 one. Okay, well, maybe we can make that work. But you see how you can manipulate your cash, and we're talking about taking a 3-week obligation, pushing it at 5, and now we didn't run out of money simply because we knew what we were doing with cash. Now, you're going to have a lot of variation. It's not going to be real. And every week, you're going to look at these numbers and adjust it so that it makes more sense for what has happened in the previous week. Same thing with accounts receivable. If your sales are going up, your accounts receivable are going to go down. Or excuse me, they're going to go up. If your sales go up, your accounts receivable are going to go up because you're extending more credit. So let's take a look at that for a minute. What can we do to control that? Here we were able to take asset purchases and move them around. But what can we do over here? Well, what I've done is I've shown you that we've got a pattern down here in terms of days. And these days are just going along. Well, when you get to 45 days, you ought to be jumping on that. And this is one of Ed's hot buttons. It's like, get on the phone. And so we managed to get these next weeks out, and then we made a lot of progress. Well, we got a lot more cash in because we paid attention to our accounts receivable. And so now it drops to here. In fact, we got it down to 28 days. So everything's looking good. We paid for this. We forget about accounts receivable, and our cash goes along. And then pretty soon it starts getting slowly worse. We're back up to 45 days again. So you see, each of the components that are in here can be looked at and reviewed. And so, you use this bottom line in terms of your cash to determine what you have to do differently. Because if we run out of cash and we haven't got any planning, what is the first thing you do? First thing you do is you count expenses.
Sorry.
Go ahead. What was that?
Panic.
Yeah. Well, yeah. And right after you panic, then you start cutting expenses. Now, cutting expenses is always a good thing, and Ed is one who really believes, and he's gone through the fire. He knows what cutting expenses is like, especially when you have a business that's having falling revenue. And that's something that is required in most businesses. You can't, you want to be as efficient as possible so that you don't have to cut expenses. Sometimes you have to cut expenses, but it's hard. It is really hard because cutting expenses means firing people. And that's, of course, in this day and age, there are a lot of people that have fired a lot of people. As a matter of fact, I don't know if we've ever had so many people lose their jobs so fast in the history of this country. Only war could be as bad as what's happened, it seems to me. I don't know, Ed, have you ever experienced anything like this?
Never.
Yeah.
And what's really interesting about it is that it caught everybody by surprise. Nobody was anticipating anything like this.
Right. That's what they call a black swan event.
Yeah. So what they've been doing is everybody's been worried about the next recession and trying to optimize their profitability before that hits. And then at that point in time, trying to conserve. Well, this caught us all by surprise. So if you were operating in the red, or if you were operating with very little water in the bucket, you all of a sudden became very much exposed. And that's why we're going to lose a lot of businesses because of this. And I
Yeah,
think that was what was discussed at the beginning of this meeting.
yeah, yeah. I think that's exactly right. And the sad part here is that if you don't understand your cash position, you don't even know what to do. Um, there are some very tough situations out there. And I will say that advising people on these kinds of financial matters is no small deal. This requires a lot of deep understanding of business and how money flows through business, because making the wrong decision can literally put you out of business if you're not already out with what's going on right now. I mean, it's pretty bad. But there's another whole side to that, and that is, well, for those people who are out of business, should they go back into business? You know, what are the prospects if you go back into business? So let's just say this business is pretty good, but let's also say that that your business dries up to, say, 2000. Well, now we take that and just say we're just going to do takeout business from here on out. Well, take a look at what happens to your business. Oh my gosh. I mean, we're down $75,000, $90,000 by the end of week 15. Do you want to come back to business if that's what you've got? So you come into your business and you say, well, we're going to put in a whole bunch of new loan proceeds. We're going to put in, we'll just guess, we'll just say we're going to throw in $50,000 from the government, because now let's see what happens. That makes us look really good, but look how fast it goes down to nothing. You're still $40,000 in the hole by the week 15. So what are we saving here? Why are we doing it? This is a very, very serious issue. And nobody is talking about this. Nobody. I've written 2 articles that I'm going to be throwing up on the MicroGiants blog here in the next 2 days. But I've done 2 examples. One is a restaurant, and then the other one is a retail store. Because what happens to a retail store is an inventory problem. If you happen to be a women's dress shop, and you've got 3 or 4 or 5 employees, and you're going along doing reasonably well, maybe if you've got a really nice shop and doing, say, $1 million, which is, you know, better than average, you could make $40,000, $30,000, $60,000 a year, $70,000 a year in a business like that. But if your inventory, in order to be able to do $1 million, you're going to have $250,000 of retail inventory, and rough, and that translates into cost is about $125,000. But by the time your inventory goes out of style, your cost of goods just went from about 55% to 85%, because you have to throw that stuff away. Now, I don't literally mean take it out to the trash, but I'm talking about a $100 dress that sells for $15 or $20 that you paid $45 for. So you buy it for $45, you mark it up to $100, nobody buys it, and in order to get rid of it, you have to put it at $20. Look at the huge loss there. The devaluation of a women's operation, which should be turning at 4 or 5 times a year. That means an average inventory of 2.5 months if you're doing really well. Well, how long have we been closed? About 2 months, month and a half. 30 days, that inventory is going to be rotten. So when I was doing consulting for just exclusively for the specialty retail industry, I did that for 7 years. That's how I got into consulting. When I started doing that, we used to use an example to help owners of retail stores understand what their inventory was. And that was basically, Your inventory hanging on the shelf is exactly like a banana hanging on the shelf. It's going to turn brown. And when it's brown, nobody will buy it. So sell it while it's green. Well, I can tell you, it's not green anymore after 2.5 or 3 months. It's brown. Maybe not black, but it's brown. So you got a huge, huge problem. So it looks to me like just being out of business for 2.5 months, most women's stores will have to take a hit equivalent to 100% of their inventory, or say 80% of their inventory. That's going to be, in a $1 million case, that's going to be a $125,000 net loss. Well, that's equivalent to coming down to the cost of goods sold line. And instead of it being 8,000, 10,000, 10,000, 10,000, going to 40,000, roughly, I'm just guessing here. And it's going to be $40,000 loss all of those months. And you can see how fast now this poor shop owner, if she stays open 15 weeks, is upside down $130,000. But you say, oh, but we opened back up, so we're going to do more business. Okay. And then the shock is kind of over and we stay fairly flat. Now let's see, how are we doing? Gee, we only lost $62,000 now. Great business, huh? Is that a great business model? So now, Ed, when you say a lot of people are not going to make it, I got to say, I think you're right on the money.
Yeah.
How do you empathize with this? I mean, how do you deliver the message? How do you let them know you don't have the skills to figure this out? Do we have the ability to let you know these are the calculations you have to make? Otherwise, if you can't figure it out, intuition's gonna kick in. Oh man. Anyways,
in my experience, well, you're going to have to do that, Edgar. That's you and David's job. You got to get this. You got to get this information out, because this is reality that we're talking about. It's this is numbers don't really lie. Yes, my forecast can be off a little bit or a lot, but you can see that you have to go through the exercise, or you really have no concept of where you are.
Here's an experience that I have, and I made notes because I wanted to bring it up. The disconnect. Why do I call myself a business connection specialist? Is because the disconnect that there is from perception of business owners that are successful, that have a $5 million company, that have no idea these type of formulas exist, and they rely on accountants and CPAs and things like that because they think the information's there, but it's not. And the first time that I run into a cash flow forecast is through you, Ron, and basically in the last maybe 3 months, and I've been in banking almost 4 years.
Right.
And even though I've been able to see financial statements, I still feel they're not accurate. They're only meant to be able to display what the tax industry wants to do to be able to avoid paying taxes, not to really understand your profitability. So what if you're dealing with a $5 million?
Now, but let me clarify. We haven't learned anything about profitability in this cash flow forecast.
And so I guess
But it doesn't matter, Edgar.
Yeah.
You don't stay in business based on profitable sales. Now, ultimately, if you're not profitable for years and years and years, yes, that will eventually get you. But you can mitigate that by taking half your salary and putting it back in, or wherever the money could come from. And you would be surprised how many businesses do that. I once had a client who wanted to have a dress store. She was a good buyer. She had a good eye for buying the right stuff, was able to forecast 3, 4, 5 months in the future as to what women would be buying. So she had all the right tools to be able to do the creative side of it. It requires both. But she had absolutely no understanding of math, no understanding of how much to buy. So she constantly overbought. And so my job was to get her to use what we call open to buy forecasting, which calculates how much inventory is going to be required in order to be able to have X number of sales that are profitable. Others, they have a gross margin after you sell them that still allows you to make some money. Well, because you have X number of people who come into the store, because you buy more inventory doesn't mean you're somehow sucking more buyers into your store. You have X amount of traffic. Now, you might be able to sell an occasional additional piece if you have more inventory. But as often as not, you'll only sell a couple more sale items, and you're not making money on those. So the way that you maintain your margin is by making sure that you've got the right inventory at the right time that is not old and stale, but it's new and fresh, and the buyer says it will be gone the next time I walk in the store. But what happens when somebody buys something that works well? They buy more of it. And what they've done is they had 100 people walk in the store that month, and they got 5 people to buy them. And so they buy 5 more of a particular dress. All 5 people who wanted the dress already bought them. The next 5 go on sale. That's the mentality, because people don't understand how complicated this is. And buying merchandise that is seasonally or fashion-wise, it becomes obsolete, is extremely, extremely difficult to do. And these tools, fortunately, they're available by companies that do this, but these tools are not typically understood. And I would say, in an example like that, the number of independent, women's wear stores that have inventory that is healthy and that they're successful is in the range of 1 out of 30 or 40. And that's why you don't see very many of them anymore. Now, menswear stores, when I was growing up, every little town had at least 2, if not 3, full-blown menswear stores. Now you don't see a menswear store in any small towns. They don't exist anymore. Why? They had no idea what they were doing. They just continued to buy inventory and buy inventory. They did. They just kept buying and buying. And eventually they had a whole store full of crap. And that's just kind of the way it is. So you see Men's Warehouse, they literally have driven out all the independent menswear stores. Why? They know this stuff. None of the other ones did. And that's why you see, I think they're probably gone now. There used to be exactly 1 menswear store in San Bernardino. I'm not familiar with a single menswear store in Riverside. They don't exist. They didn't stay up with the times. They didn't understand merchandising. So what we're seeing is the playing out of a lot of ignorance, because business is a lot more complicated than they think it is.
And so right now, if they were to understand even a glimpse of what cash flow forecasting is, then you take the information and say, okay, well, how do I increase sales? Is it even impossible? How do I market to a specific target audience? Do I go on and say, okay, well, and now it's obvious that I'm going to fail. I have overhead. I have, what do you call it? My faucets, they're all open.
Yeah.
Right. And then this virus just came in with a massive shotgun and blasted a hole in my, and no more money's coming in. And there's a big hole in my bucket.
Yeah.
So it just comes down to each independent. This is what you went when we talked on Monday. This is what you're talking about. It comes to each independent business to analyze themselves and find out if this is a big hole that could be patched,
right,
or there's just no hope for this bucket and
right.
Abandon ship.
Right. So the guy next door, lives next to me, has a gym, been pretty successful. As a young guy, I think he's got several hundred people who come in to, do classes and that sort of thing. And of course, he had to close immediately. He has a $9,000 rent number every single month. And he's gone from whatever it was, where he's making a decent living and his partner, to 0 income. So he said, he said to me, I only have 2 months rent left in the bank. And so if we go more than 2 months, I'm going to be, not only am I going to be out of business, I'm going to be bankrupt. Well, he's not a dumb guy. I've overheard him, because he lives in the front yard now, it seems like, and I can hear all of his telephone conversations. And so as he's walking around, because he's got too much energy, he's this buff guy, you know, and he's doing exercises and stuff and talking on the phone. And you know, I can tell he's not a stupid guy. You know, he's not a typical kind of dumb athlete or something. I mean, he's reasonably intelligent about numbers and talking about business reviving and keeping people safe and how can they get things started. So I told him right away, I said, you know, get in and talk to your landlord. I mean, that's too big of a number. I mean, you're not going to be able, you know, not going to be able to pay that, and you shouldn't, because you've got to conserve cash. And so the issue now is, well, how much cash have you conserved, and did you stop paying your bills? Now it's pushing it to somebody else, and you can talk about the moral issues of paying your bills. You can also talk about the moral issues of staying in business so that you can pay your bills, or staying in business so that you can employ your people. So I mean, that's a tough question, really. That's kind of a tough issue. So he was able to go in. Fortunately, he went in, he had a conversation with his landlord, and the landlord said, look, for 2 months, I'll give you 50% back, or I won't charge you half. The other half, I'm going to take that and spread that out over a year. It's like, wow, eureka. You know what? You might be able to make that work. Well, I would have rather have said to him, let's do a cash flow forecast here. You know, it's like, let's take this money, let's plug it in, you know, what you've got, what your expenses are, what your startup costs are going to be. Let's determine how the cash is really going to flow, because can you afford to pay this off? I think he can. I think he can. But in my restaurant example, the guy was going to be so far upside down that based on the money he'd make, it would have taken him many years to pay back the loan that he would have to take out in order to stay in business, because you know, you hit a certain capacity and you can't do any more business in a restaurant. There's just no more business to be had. You know, and if you're at that capacity, it's like, what do you do? How do you really mitigate that? There are things you can do, but you need to know where to focus. And by following the cash, it gives you a leg up. So let me say, before I forget, the first thing that people should be doing is the break-even analysis. And then the second thing should be the cash flow projections, to determine and make a reasonable stab at whether or not these scenarios work. And you can see how easy it is just to simply take a cash flow, you know, take one of these lines and say, okay, here's the loan. What happens if we don't get it? Bam, just erase that. And now you can take a look and see how that changes. Now, if you're good with spreadsheet sheets, you can also use the scenario analysis tool to change multiple variables and be able to determine what it's going to take in order to get it done. But, you know, just a straightforward way, you just delete it, you move it, you add it, and you can see where you are in a way that gives you some kind of understanding of how this is going to be based on starting up in 3 weeks, starting up in 4 weeks, starting up in 5 weeks. So for instance, if you said, we're not going to be in business for this many weeks, you just go, okay, what does that mean? Well, we're going to lose this much money, this much money, this much money, this much money. Well, how much would we continue to lose? Well, I don't know. Can you handle a loss of 144,000? Maybe you shouldn't open up then. Because that might be too deep for some people. Now, it depends on where you are. If you happen to own a home and you've you know, given your put your signature on that loan, they're going to come after your house. Do you want to risk your business and your house at the same time? Or would you rather just let your business go and start over when it makes more sense? If you don't have any assets, can you just stop business and start over again? And you know, or can you just pay off whatever portion you have against your house and then start over again that way? So you see, it depends on where you are in terms of how much you're going to have to pay back. No one likes to talk about the options of who's going to lose money because you went out of business. You know, is it going to be you? Is it going to be your vendors? Is it going to be, you know, could be your customers if you promise them something that you don't deliver. Could be the bank. A lot of people lose money in a situation like this. The question is, how much can you stand to lose? And what's the best for everybody? It's not an easy decision. This is not, and this kind of advising is not something to be taken lightly, because people's lives are at stake here. So, Ed, are you still? It looks like Ed took off. Okay. Other questions and comments? We've got about 10, 15 minutes to kind of hash this over before we move on to the next subject.
David?
I'm clear, very thorough, very detailed, and you know, it's a lot of what we myself as I see, you know, balance sheets and P&Ls, you know, from trying to qualify people for loans, and they think, in my experience, you know, you got a debt service coverage that you're trying to accomplish for the bank's part.
Yeah,
which,
right.
If you're getting a bank loan, a lot of people are thinking that business must be doing well because I'm getting a loan, but the bank is not your friend. The bank is basically just telling you that you can qualify for this certain debt service, but it doesn't really say anything about your cash flow at the end. So I see a lot of people fall into that trap to thinking that business is healthy because I just got a loan, but there's that debt service once, you know, expenses starting to hit. So, but very detailed.
Well, and isn't it true? I mean, we got, you know, a couple of bankers here. I mean, isn't it true that you might take a look at what the ability to pay back is in the shorter term, but in the longer term, you're really looking at what's your worst case scenario and what can we sell to recover our cash. So if you've got liens on all the equipment in a business, and you know, they borrow $100,000, but you've got liens on $1 million of equipment that you know you can get rid of for $200,000. It's like you're not really concerned about their cash flow, are you?
No.
Let's talk about it the way it really is. That's the way it really is. Bankers don't really give a damn about what the cash flow is because they only care about being whole. And that's the. I wouldn't be any different if I was a banker now. So because you know you've got to have security and you've got all kinds of regulations on how you do this. All I'm saying is, if bankers cared, they'd be doing cash flow statements for their customers. They don't care, and it's the same thing for CPAs. But it's not that they don't care; is that they're scared to death they'll get sued because they didn't get the sales projections right. And banks may have that concern as well. And so it leaves it to really well-informed consultants. You know, business consultants with lots of experience that can do this, or the owners. The owners can do it, and it's not going to be that bad. Owners can do this stuff. This isn't that hard. It really isn't.
Definitely agree, and I think that's where the hole we're fill the void up is being able to educate these owners and business owners that, you know, don't rely on the CPA and don't rely on your banker, and really dive into your numbers and your books to really get a feel for, if things were to stop today, how long do I have to last? And that should really open your eyes up to say, you know, if I don't have more than 6 months of reserves for something to just catastrophically end, then I got to start either trimming some fat off of my expenses or thinking about, you know, where am I going to get additional revenue from? Right. Really, that's what happened now.
And so if here we are in front of 2,000 people, the type of advice shouldn't be, this is what you should do. It would be like, all right, there's only about two type of breeds of people or content that you can, there's two breeds of people you could go out for this type of advice you're looking for that you're not going to find on the Facebook page. It's either going to be some sort of consultant that you're going to pay money to do these cash flow forecasts for you, or you're going to have to focus on self-development and understand how to do this yourself because CPAs, bankers are not going to do it for you. And I think it's because of the fact that, like you said, if they're scared of doing it because they get sued, and these are the platforms and people that have the talent to do so. So at this time is, all right, stop watching, what do you call it, Tiger King, and maybe start watching a couple of videos on how to do cash flow forecasting, because that's the only possibility that you're going to know if you're going to survive or not.
Well, I think what the main thing that you left out of the bank balance of the bucket, Ron, is the expense for a business consultant or business coach, right?
Well, that's just too big to put in there, you know? Yeah, well, yeah, of course that's an expense. And so it's there. But I certainly wouldn't want to break that out, you know, and kind of any more than you want your banking fees to be broken out, right? You just want to be part of the whole thing.
And so if we do have 2,000 people, and I'll be honest, I don't feel confident enough to tell people. I feel confident enough to tell them, I know where you fucked up. I'm sorry. And I know where you messed up. And it's now I know, because I think I know what we messed up is because we've been learning all the wrong information. We only been learning how one of the faucets works, but we haven't been understanding how the full faucet and the funnel and the bucket and the hose work, right? And so the only way to do so is by utilizing tools that you've probably never used. And if you went to business college, you probably only talked about it 5 minutes. But break-even analysis and cash flow forecasting in times like this, it should be the number one lesson that people should be looking at. Is that an accurate statement to say, you think?
I do. I think so. Unfortunately, there just aren't very many people that do this stuff. And, you know, the only reason that I do it is because I've been there and I had to do it. Because I've started 6 businesses, and I had to learn how to do it, or else I was just going to fail and I was going to lose all my money. And I've lost a lot of money in my life. You know, I made a lot of money and I've lost a lot. And, you know, fortunately I'm ending up with some, and I've got my retirement already funded and everything. But I'll tell you, there's a certain amount of luck that comes along, that we all get certain breaks in business. But had I not figured this thing out, I would have lost a lot more money in the retail business, especially a lot, you know, earlier than I did. And I wouldn't have made it as long as we were able to. And you know, and we had a good business, and I made a lot of money, and I was able to put it in real estate. And fortunately, when things got rough, I moved on, and my partner was not, you know, based on his ability, my partner wasn't able to sustain the business at all. But he learned from it too. And he now is a multi-millionaire. And he learned where the mistakes were along with me, and what we had to do a little bit better in order to be able to do it, and not to push your business faster than you can grow cash flow. That's the deal. You cannot outgrow your cash flow and hope to keep your business growing. And of course, what happens is that it automatically shuts down. You know, if you run out of cash, you begin to do, people make decent decisions. They buy less, they cut expenses, they start pushing marketing a little bit more, try to increase business. They do the right things intuitively. It's just that they're not able to really calculate how much of one thing to do and how much of another thing to do. And therefore you get a lot of business people that have huge swings. They make an emotional decision that they have just got to get out of debt, and therefore they're going to fire 3 of their best people because they're the highest paid. And then they realize those three of their really good people knew a lot more about their business than they thought they did, and now they're lost. You know, those are kinds of decisions that are made that are irrational decisions because the numbers are not known.
That was quite really interesting, Ron. Thank you for this presentation, because before I came aboard in the business, my father he ran the operations and not really paid attention to any of this like this. He's one of those individuals that Edgar was talking about earlier. But ever since I came in, and like even a great point, Edgar, even in at the university I've been to, I've been at City College at Chaffey, now at Cal State San Bernardino. These types of subjects are hardly touched upon. It's usually on the vague part of all this, and it's not really in detail with this. But yeah, ever since I've been on board, I've been calculating on my own and trying to figure out our cash flow and how everything is in our end. But this has put it even into a deeper and bigger perception. Like now I can see where I was doing it wrong, or where I needed to fix it, or how I should be maintaining this. But yeah, it is very important in these times to be on top of the cash flow.
David, if you don't know this, I met Christian at Wells Fargo, and he came to me asking for help that I knew I could not provide. And so I dragged him to the BNI team. I dragged him to the MicroGiants. And I told him, like, yes, I can help. I know a lot about the lending world, but the intuition took me to tell you, it's like the information you're looking for, you're not going to find it. Your CPA and all that. And I relate a lot to Christian because it's the Latino Hispano father that that I kind of know how to pierce through those. I already know enough to say, yeah, I can't teach your father, and I won't teach your father. I mean, if anybody, is going to be you, and because of that trust situation and everything. So since then, I just told Christian, tag along, see if you learn anything.
Yeah. Well, I'm glad that worked out that way. And so we're just about done with our time. And I think we're coming to a natural ending for like session 1. And we'll continue on with this subject, get a little bit more detailed in our next meeting. And we'll also talk a little bit more about these circumstances of maybe when not to go into business. I'm sorry, you're hearing a whole bunch of dings on my computer here. I hope that's not.
Oh, okay. I was as long as it's not me.
No, there's something going on, and I can't even figure out. I've got all my notifications shut off. I can't figure out what's going on with it. So I apologize for that. I'll see if I can stop it somehow. So anyway, we'll continue on because this is a big subject, and we'll have an opportunity to talk more about the loans and some of these other issues that businesses are going to have like right away. So and meanwhile, I'm going to be. I'll put you on the list for the new blogs that are coming out that have this subject kind of expanded a little bit more. And you guys are welcome to the spreadsheet if you want to use it and start building your own. So just let me know.
Please, if you can send it to us. And what else? Aside the MicroGiants, John, Ron, John is the David. John is the his son. He introduced me to it.
Yeah.
But I was gonna say, oh yeah, I would love to see maybe later on if you have time. I would like to talk to you with David and see if you could help us potentially figure it out what approach we can take with that group. Mostly because I kind of wanted to. I got a lot of notes about maybe focusing on those subjects, survival and cash flow,
Yeah.
but more specifically, the type of tools that you should be studying.
Yeah.
Break even and cash flow forecasting.
Sure, happy to do it anytime. Tomorrow is really much completely open until that. So just let me know.
Okay, we'll see if we could schedule something in. It'd be awesome to kind of get your opinion on how to potentially approach this.
Sure, sounds good. Be happy to.
Awesome.
Okay, everybody. Hey, thanks. Good meeting. Appreciate all you new folks for showing up, and all you old folks too. So we will see you all together again in a couple of weeks.
Awesome. All right, thank you.
Ron, take care.
See you now.
Bye.
See ya.